Hello, everybody. This is Leo Kelly, CEO of Verdance Capital Advisors, and I'm here today to give you an update on the markets and the volatility in all of the financial markets that's been going on here in recent weeks. It is June 15th. Today, we heard from the Federal Reserve that they raised rates 0.75%, one of the largest increases we've seen in a long time, over a decade, and that is to fight what is the headline in every economic paper, and that is inflation. This first chart will show you this is a massive breakout of inflation, only really rivaled by the 1970s, early 1980s massive inflation we saw, where Paul Volcker had to come in and break the back of inflation by raising interest rates significantly. And so here's the Fed for the first time, and I believe well too late, starting to fight this inflation. We're in the high eights. It has to come down. It's very problematic. It's an insidious tax on everyone, but especially the lower middle class population. So we've got to fight inflation. Why? What is it doing? Well, inflation is having a pretty dramatic impact on all of the financial markets. This first chart shows that yields are breaking out to the upside. Now, what does that mean? When yields go up, bond prices go down. The reverse is true. When they go down, bond prices go up. This chart shows that we've been in a 40-year bull market, a 40-year bull market, and we're breaking out of that bull market. And we think going into a secular bear market in interest rates. That means interest rates are going to go up for a long time. Now, that's good news when we get there and we could start to buy bonds at higher interest rates. But for now, these rapidly rising interest rates are causing turmoil in the bond markets. Interestingly, in the first quarter of this year, it's the worst bond market we have ever seen. We saw investment-grade bonds down over 12%. These are equity-type losses, and that's because of this rapid rise. So initially, that shock is impacting both bond and equity markets, specifically the growth markets and the high-risk assets. What are some of those risk assets? Well, this first chart shows cryptocurrencies. These have been the biggest risk asset of all time. They don't have an asset backing, and I could go on and on about these, but look at this decline from Bitcoin from 69,000 down to 20,000, and we don't know where the bottom is here. This is all speculative. The takeaway here is not crypto is good or bad. The takeaway is when you're in a highly speculative market and the basis for your valuation is just prices going higher, this is the risk you face. This is what you have to understand. Same thing for some stay-at-home stocks. We saw these stay-at-home stocks go through the roof, and everybody said they're going to go up forever. The world has changed, new paradigm, and they have collapsed 70, 80%. So risk speculative assets are down. They're down hard. What we are seeing, though, is value stocks starting to really show their weight. Value stocks have been doing very well, materials and energy and other stocks like that. Actually, this chart shows you that value is relatively inexpensive to growth. Now, it's come back a little bit, but look at this chart. It has a lot of room to grow. Here's another chart. Small cap, much less expensive than large. This is where we think the value opportunities are in a market like this with inflation and a change in the interest rate paradigm. This next one, international. We have to rebuild the supply chain. So the whole cause of this inflation, or at least one of the causes, is that the supply chain has been shut down. Demand is very high from all the stimulus money and all the money we've been putting into the system. We have too much demand chasing too few goods. That is the definition of inflation. Unfortunately, right now, policy has been to increase demand. That doesn't help us. We've got to increase supply. We've got to bring this inflation down. Oil, in this next chart, you see a massive upside. Now, remember, it wasn't that long in COVID. Oil actually went below zero. And we heard, well, the price will never get that high again. Well, whenever you hear it'll never happen, here it is. Oil's exploded to the upside. This is a major impact on inflation. Supply needs to be increased here. We all want clean energy. I want clean energy. It's not really a matter of a yes or no on clean energy. It's the pace in which you get there. And right now, demand is outstripping the supply of oil, and therefore we have much higher prices. So the result of all this is the market is down. People are uncertain. The economy has pulled back. We had a negative GDP report last quarter. If we get a second negative GDP report, which we're not predicting, that would actually be officially a recession. So if you're wondering why we've entered a bear market, which is 20% down from the high to the low, we've entered a bear market officially this week. You're wondering why we're there. It's because the economy is slowing down, interest rates are going up, people are concerned. Now, should you be concerned? What do? We've hit 20. Do I sell? Do I buy? Well, this is interesting. Take a look at this first chart. This is the 1987 crash. The market went down 25% in a day. So if you think it's been stressful the last few months, imagine this all happened in one day. And so here, it's easy to look at this and say, oh no, what do? I got to sell. Many people did, unfortunately. This next chart's 2009 market. This was a 50+% crash from top to bottom. And you probably remember your emotions in that moment. Despair. And yet, look at this next chart. That's these 1987 and 09 markets in the context of the S&P 500 over time. These circled areas are those traumatic events. The lesson here is simple. Stay the course. If you're an equity investor and you're trying to get good long-term returns above inflation and taxes, this is part of the game. You have to be able to put up with volatility, and we're going to have volatility. In fact, with rising interest rates, volatility will increase over time. I really like this last chart. This maybe will give you a little bit of hope. This last chart looks at every bear market down 20%. And it says, okay, if we invested the day a market officially goes into a bear, down 20%, what happens? Well, as you can see, it doesn't always stop going down. There's a lot of bear markets in here, down 30, down 40, down 50. So if you were to make that decision every time, yes, you could put it in and you could watch it keep going down. Yes, today this market could keep going down. Bear markets are unpredictable. But we're not traders, we're investors. So what happens after 1 year, after 3 years, after 5 years, after 10 years if we invest every time the market goes into a bear? Well, this chart shows you, sure, in 1 year there's a couple times where the market was down, but mostly it's up. Same thing, only one time 3 years, only one time in 5 years did you have a down return, and never over a 10-year period. So if you're a long-term investor, investing the day we hit down 20 is actually an interesting time to invest. In fact, if you look at the average returns, look at these returns. 18% for 1 year, 37%, 51% for 5, 155% for 10 years. These are big returns, and that's the average of all markets that have hit a 20% downside. So the lesson to be learned here is equity investing is a long-term gain. Volatility is a part of that, and we're entering a new world. People are not used to a rising bond interest rate market, and so we're going to have to adjust our thinking a little bit. So what to do? Well, again, we think we want to put money to work when assets are cheaper. We have to be careful with the bond market because we think this is longer term. So we're going to stay short on your bonds. We're going to stay higher quality. We're going to look for opportunities to invest in equities where they're cheap. That's international, small cap, value. And we do like the private markets, private credit, private equity. They look interesting to us. Now, that said, we have to be far more discerning in that market. It's going to take a lot of rigor, a lot of discipline, looking for those niche plays that make a difference in your portfolio. So I hope this was helpful. There's a lot happening here. We've got a lot of volatility. We've got a lot of headlines in front of us. And I understand that that can cause some angst as you're going through and you're seeing your portfolio go up and down. By all means, we have two requests. One, stay the course, stay calm, and understand it's a long-term game. And two, please call us if you have any questions. Call us if you're concerned. That's what we're here for. We're happy to have a conversation. Thank you very much. Have a wonderful day, and I hope you have a wonderful summer.